Once you've got a trade open, and especially when it's in profit, there are a whole bunch of decisions that you have to make. But among those, there's one important decision that I make each time that I think gets overlooked by most traders. The decision is about which approach to take when closing the trade in profit. And this should be based on what's most logical for the type of opportunity I'm trading. I broadly put this into two categories. I can either take a defensive or an offensive approach. Now, in general, what I see from most traders is that they'll have a bias for one particular exit approach. Sometimes this is dictated by their trading system. For example, they might always take multiple partials at different key levels. Sometimes they don't even make the decision ahead of time and they just leave it to their gut feeling or emotions. Like when they get nervous, loss aversion kicks in and they grab the profit while they still can. And a lot of the time it's based on people's risk tolerance. So more risk-averse people will be defensive and risk seekers will be more aggressive. Instead, just like how I approach all areas of my trading, I think there should be some logic behind the decision. You know, most traders only think about their trading strategy in terms of the criteria they need to enter a trade. But you should also think about the strategy you're using to execute, manage, and exit the trade. And that strategy should change based on the opportunity. So I want to explain to you the logic that I use, and then you can decide whether this is something that you want to adopt for your own trading. And I'd be delighted if you do, and I'd love to hear about it in the comment section down below, any changes that you've chosen to make. You know, this approach, it's not complicated, it's actually really simple. But the idea here, the idea of this video and the channel in general, is to help you to be more conscious and more logical about the decisions that you make with your trading. So first, let me give you a quick high-level overview of an important aspect of my trading. When I enter a trade, I'm not doing that because I believe that individual trade will be profitable. Instead, I'm entering a trade when an opportunity has a positive expectancy above a particular margin of error. And I figure this out by assessing the potential outcomes and then estimating the probabilities of each of those outcomes happening. So for the first order outcomes, one will be negative and would put me into a loss, and the other would be positive and put me into a profit. Then from that point onwards, after entering the trade, my trade management decisions are mostly based on the same. I assess the next potential outcomes and estimate the probabilities of those, so that way I have an idea of the expectancy and I can take an appropriate action based on that. And I believe that this is the most logical way to make trading decisions. Now, there's obviously a lot more to it than just that, but that's just a brief bit of background info to help you follow along with this video. And if you want to understand more about this and how to apply it to your own trading, check out the link in the description, there's a video there for you. So let's say I'm in a profitable trade and the price has completed the first order outcome. I know that this is an area where there's likely to be a shift in activity, which means there's a higher risk at this point that the price may move against me. So at this point, the action I take will differ depending on whether I've chosen a defensive or offensive approach for exiting the trade. A defensive approach means I want to protect my capital as much as possible, including the profit that I've built up on this open position. Whereas an offensive approach means I'm willing to risk more of that profit for the potential of earning an even bigger return. So let's think about why there might be a difference. We know that even when the price is moving heavily in a profitable direction for us, most of the time there will still be moments when the price moves against us. That's just part of the price discovery process. Sometimes it will be a minor fluctuation, but the longer you hold a trade for, the more chance there is for entire moves against you. To put it in simple terms, if you're in a bearish trend and you have lower highs, those are still moments where the price was moving against you for a prolonged period of time and you had to make a decision whether to hold on to the trade or not. So for a defensive approach, I'm making the decision that I don't want to wait for one of those pullbacks against me. I'd rather close the trade and bank that profit now. This would be appropriate for situations where the expectancy on the next potential outcomes is much lower and it no longer makes sense to take that risk. It shouldn't just be based on how I feel and loss aversion and things like that. It should be based on the logic of the opportunity. On the other hand, if I'm taking an offensive approach, I'm willing to stay in the trade. But that doesn't mean that I want to allow the price to move all the way against me until all the profit is wiped out. Instead, I'm going to move my stop order into a profitable position, so I'm allowing the price to move against me to a certain extent to have its pullback before continuing the next move in the direction I want it to. but any further than that point and I'll be out of the trade for a lower profit than I would have had if I'd taken the defensive approach. If I've taken that decision, it means that I believe the next potential outcomes give a positive expectancy for my trade. Now, that part is relatively straightforward. The more tricky question is where I should move my stop loss to. If it's too close, the price might easily trigger it before then moving where I wanted it to. But if it's too far away, I'm unnecessarily risking more of my profit. So the answer, as always, is to base it on probabilities. I want to move my stop loss to the point where the probability of it retesting my entry point is so high that it's no longer viable to stay in that trade any longer. In other words, it's the point where the expectancy for staying in the trade beyond that is negative. So beyond that point, it's no longer logical to be holding that risk. Therefore, I need to be actively analysing the markets even after the point of entry. Now, that doesn't mean that I need to analyse every single price tick. It just means I need to identify where there are levels or areas that may cause a shift in activity in the markets, meaning a change in the balance between volume and liquidity. By identifying those areas, it allows me to estimate the probabilities of different potential price moves. And again, just like I mentioned earlier, if you want to understand that side of things in much more detail, check the link below for the free training. It's beyond the scope of this video, otherwise this would end up being over an hour long. But you know, things always sound great in theory, but the thing about the markets is that things aren't always black and white. Sometimes you might need to start with an offensive approach, and after certain price movements take place, you then switch to a more defensive approach. In fact, that's what happens most often when you get those huge runaway trades that have a huge profit where you're just riding the trend. And sometimes an opportunity will call for a mix of both approaches at the same time. For example, let's go through a recent trade that I took on pound yen. So you can see it here. The price was in a short-term range and the situation met my criteria for a short trade entry towards the top. I had positive expectancy. But the situation wasn't entirely straightforward. You see, at this time, all yen pairs were slowly grinding higher as the yen continued to weaken, and I knew there was a good chance that that would continue. So after the initial profitable move, if I had one, I knew that any pullbacks could be a sign that the bullish trend is continuing and the price would then break through my entry point, therefore putting me into a loss. But on the other hand, there was also an expectation in the market that at any time, Japanese policymakers could intervene in the market to strengthen the yen, as they'd already done recently. There were loads of comments coming out from policymakers saying that they were concerned about the situation with the yen and they were monitoring it for potential intervention. So if that did happen, there would be a huge bearish surge and I'd make a huge profit. So in this situation, I decided to split the trade and take both a defensive and offensive approach at the same time. And what happened next, after I entered the trade, a comment came out from a key policymaker suggesting once again that they were considering intervention. And so pound yen dropped rapidly to my first key level. At that point, after risking just 0.6% on the trade initially, that was the total amount at risk, I was already up over 2% in profit. So I split the trade. One half was short-term focused and the other half was longer-term focused. The short-term focused one was a defensive approach, so I closed it and banked a 1% profit because there was a good chance that the price would reverse from that point, and so it didn't make sense for the short-term market context to stay in the trade if I was just focused on the short term. The expectancy wasn't high enough, there was too much risk, so it's best to take a defensive approach and take the profit. Then for the longer term part of the trade, I decided to take the offensive approach. So I kept the trade open, but moved my stop loss to break even. Now, moving the stop loss to break even wasn't because that's where my entry point was, it's because that was the point on the chart that I recognized that activity could change in the market. So if the price got back to my entry point, the probability was high that it would break through and therefore continue to move higher. But if it didn't reach there, the probabilities were higher for a further move down into profit for me. Now, as you can see, in the end, the price did reverse and eventually hit my stop loss and broke through. So I was left with just the 1% profit that I banked from the defensive approach on the short-term part of the trade. Now, that's just one simple example, but in different situations with different contexts, different levels, different opportunities, the logic will change. Rather than having a set and forget approach where I just open a trade and wait for it to hit my profit target and hope for the best, I'm tailoring my strategy around what's right for the opportunity. And in fact, that same approach that I explained to you of pound yen, I was doing that all of the time with the different yen pairs, and I was explaining it to our members, waiting for that big bearish move to happen. And as you can see from the chart behind me, recently it did happen. So I just take that approach over and over again if the context is showing that it's right to do that. If I get the signal for a short-term entry, then I'll enter the trade. Once the trade is in profit, I can then split the time horizons, be defensive on one part and aggressive with the other part, and I'll slowly build a positive return on the short-term position and still have the chance for a runaway trade when Japan takes action on the other part of the trade. You know, as I said before, it's not complicated, it's actually very simple. But the important part here is about using the probabilities and the expectancy of the situation to make the most logical decisions, rather than just taking a blanket set and forget approach for all trades in just the exact same way. And if you want more examples of different situations, or to understand the other decisions that I make with my trade management, let me know by hitting the like button on the video and leaving a comment below. Things don't have to be complicated, but they should always be logical. And hopefully I can encourage you to start thinking that way too.